Good morning and welcome to 5 Before the Bell, TheStreet.com's daily market preview and global and European market update right here from the heart of the financial district in central London. I'm Martin Baccardax. I'm the London Bureau Chief here at TheStreet.com. I'm going to take you through those 5 things you need to know before the bell. There's a lot more than 5 as there typically is, but we're going to start right with European stocks because we're looking at our third consecutive day of declines around the region. There was an attempted stabilization overnight in Asia, it has to be said, as investors were sort of picking apart the statements made by both President Donald Trump and officials in North Korea with respect to the saber rattling that has intensified significantly this week after, of course, UN Security Council sanctions were put in place over the weekend, and North Korea has talked about firing missiles on the U.S. territory of Guam. It's a very dangerous and it is a very simmering situation indeed, and I think that's part of the reason why investors haven't been able to sort of pull themselves away from the risk-averse nature of this, simply because we haven't seen two leaders who are so inexperienced come so close together with the stakes so high, and I think that's part of the reason why you're seeing the drift that you are. Safe haven assets are once again in play. The Swiss franc is rising, gold is rising. We'll talk about the reasons why in a little bit, and we're also seeing a little bit better bid in the US dollar. We're also seeing Treasury bond yields held at around 6-week lows, not quite where we were yesterday, but very close to that at around 2.23%, and a similar 6-month low for benchmark 10-year German bunds. That's essentially a proxy for European borrowing costs at the high end, and they're trading at about 43 basis points, and again, that's very close to 6-week lows. But again, red across the board, we're pulling Wall Street futures a little bit lower. The underlying corporate fundamentals weren't great this morning. There was a mixed set of earnings from around the region, and I think that's part of the reason why that stocks weren't able to find a positive footing. But nonetheless, given the fact that you are seeing these simmering tensions and the consistent moving of cash into safe haven assets, that's enough, more than enough reason, I think, for investors to take risk off the table, particularly when you consider the global stocks hit an all-time high only late last week. All right, we're going to move on to one of the more interesting stories that I would imagine is going to develop the financial world today, and that is with respect to Charter Communications. You remember yesterday there had been some reports that Altice, which is a European group headed by billionaire Patrick Drahi, was potentially putting together a bid that could be worth about $180 billion for Charter, which is the #2 cable provider in the United States. Now, Charter shares were up about 3% yesterday, and they've gained about 14 or 15% over the last couple of months amid persistent takeover speculation. They're in the crosshairs, if you believe the media reports, of SoftBank, potentially Verizon, and also, it seems, potentially Altice. Now, Altice is an interesting group in and of itself. It floated in the United States, or at least a U.S. business did, back in June, and that gave it some share firepower that it might be able to use in acquisitions. Patrick Drahi is a French billionaire. He's worth about $14 billion, according to Forbes, which makes him one of the richest men in the world. Despite the pronunciation of his surname, it's spelled differently, and there is no relation between him and the European Central Bank president, in case anybody was concerned about that. However, what the reports say is that Drahi may be able to use his favorite technique of ramping up debt, taking over a company, and then immediately cutting costs in order to increase margins and therefore increase profitability and therefore refinance the debt that he used in the first place. This would be a pretty titanic offering, though, even by Mr. Drahi's standards, because you're looking at, again, a price tag of about $180 billion. That would be several times over the combined market cap of Altice and Altice USA, and those groups are already burdened with about 32 billion euros in debt as we sit at the moment, and there is increasing concern about bubbles in the corporate bond market given the fact that interest rates have remained so low for so long. But it's worth remembering yesterday, of course, and the day before, British American Tobacco got off significantly attractive financing in their corporate bond offering in dollars, in euros, and in sterling. They weren't the most amazing prices, but you're looking at British American Tobacco borrowing at a 30-year tenor. It's only about 1.5 points over U.S. Treasuries. For my money, that's pretty darn good for a company that still faces litigation risk and still faces some business risk changes, given the way that people are giving up smoking and going into vaping. But I digress. The Altice story, at the moment, it is driving speculation around Charter Communications. I'm not seeing any share price movement prior to the market, but it is going to be an active one. Aside from that, Altice today made a play for the shares that it doesn't already own in a group called SFR, which is a wireless operator in France. Now, whether or not this is a consolidation play in order to ramp up the shareholder and the share price firepower in order to go after Charter is unknown at this point. But even if he's able to get the financing in place, he's still going to have to convince some of Charter's most significant shareholders, most importantly John Malone of Liberty Global. He doesn't really seem to be interested in selling the group right now because it's been a steady performer, and in fact it is outperforming many of its peers in a very difficult market. But again, consolidation changing and the landscape of the media world changing as we speak, and the Charter bid story is yet another example of that. Two interesting quarterly earnings reports are going to come today, too, one prior to the bell and one after. Blue Apron is going to give us their debut earnings prior to the opening bell today. They, of course, went public back in June with a much hyped IPO. Share price hasn't done much since then, apart from fall about 40%. It's under tremendous pressure with respect to new market entrants, including Amazon, which is going into that meal kit delivery service, which which Blue Apron is trying to dominate. Now, there are many other reasons for Blue Apron struggles at the moment. One of them is the ways in which investors look at the marketing spend budget against net revenues and whether or not that is increasing the customer base. So those numbers are going to be in the focus of investors when we see the numbers today. More broadly, Blue Apron is probably going to report a 30 cents a share loss on revenues of about $235 billion US. Those will be a little bit lower than the numbers that we had previously anticipated. But again, I do think that investors, if you were looking at this stock, you want to look at how they're retaining the customer base, how much they're spending in order to do that, and then perhaps even more importantly than that, what kind of revenue you're getting for each and every customer. If that number is rising, even if the amount of customers is falling, as long as marketing spend starts to decline, it could be a valuable proposition. And it has to be said, if you thought the stock was attractive at its $10 a share price, it's trading at around $6 right now. So if it can turn itself around and convince investors it can attack Amazon's entrance into the market, could be worth a look. Snap, after the bell, going to give us their Q2. We all know about that company and its struggles. It IPO'd at 17. It's down 44% since then. Average revenue per user, ARPU, as the analysts like to call it, will be in play once again. But still, we're looking at a 14 cents a share loss and revenues of only about $187 million. This company hasn't got off the ground yet. It simply has to be said. But nonetheless, even though Facebook has come into the market with its Instagram offering and the Instagram stories, which is stealing a lot of market share, and even though Snap is much maligned for its shareholder structure, I'm still convinced there's a compelling business model underneath it. Whether this management is the group to bring it out is another story. But I will be interested to see how they are growing the subscriber base and how the average revenue per user is growing. It was 90 cents per user last time. If you start to bump that up a little bit, come up with a compelling advertising model, you might have something. But it's a long way off from being profitable by the company's own admission, and it's not going to happen today. But we'll watch the we'll watch the earnings, of course, with interest. Come back to TheStreet.com. We'll have the live blog, I am sure, after the bell. Okay, we're going to move on and talk about gold prices because they hit $1,280 per ounce on a spot basis overnight. That is the highest we've seen in about 2 months. Now, gold futures for December delivery a little bit higher, but not too much. I'm always struck at the difference between spot and futures prices because it only anticipates a gain of about $2 or $3 between now and the delivery date. That, to me, doesn't seem to be an incredible return for something that isn't going to give you much in terms of capital gain, and of course, you're going to be subject to capital gains taxes along the same time. It has to be said, on the side of that though, despite myself being a gold skeptic, the Spider Gold ETF has gained about 10.7% so far year to date, and it is going to be buttressed by the rise in gold prices. Now, of course, gold is one of the traditional safe haven plays that we've seen over the past decade with respect to crises around the world, and given the fact that we are seeing these escalating tensions in North Korea, it's no surprise that we hit these levels. Nothing really changed in any great degree last night with respect to the North Korea story. The kingdom has basically said that they have outlined plans which they say will culminate in a strike on Guam, but analysts actually say that it is more likely a tacit indication that they have ramped up the speed of their atomic weapons program, but aren't necessarily likely to use it. There are people who parse the statements from the government very, very carefully, and they look for patterns in the wording, and those patterns do suggest that there probably isn't going to be an imminent strike. Investors aren't taking any chances, though, and I can't really blame them, and they are looking for ways ways in which to take risk off the table again when we're close to all-time highs. But it's interesting to me that gold is rising, but not to the level that you might anticipate. A lot of analysts are pointing to $1,300 an ounce as the next takeout, but we're only at $1,280, and you can't imagine that the tension is going to rise much higher between now and the time that the situation gets ironed out. So I do wonder if there's gains left to come. And the World Gold Council itself is talking about limp demand for physical gold in the second half of the year, particularly in countries like India, where the traditional wedding season normally elicits a whole lot of buying. Probably not going to get that in the second half of the year. So the upward swing in gold could be tested at this $1,280 level, and I would caution you to take a careful look before you jump in, again, as we are at 2-month highs. Okay, let's take a look at Wall Street. 59 points to the downside is what we're anticipating for the Dow Jones Industrial Average according to current futures prices. That equates to about 0.3%. If I'm looking at the NASDAQ, we're looking at about 0.6% down, or 36 points, and about 0.4% down for the broader S&P 500. Lots to get through today. As mentioned, we're going to get initial jobless claims as well as producer prices. And those numbers are going to be very, very interesting indeed as we head into key inflation data tomorrow, and that will go a long way into attempting to cement understanding of the Fed's ambitions into the second half of the year with respect to rate hikes. But we're only looking at about a 44 to 46% chance of a December hike from the Fed, according to current futures prices. And I do wonder if that's going to change if we get some tame inflation data going into the October months. At the moment as well, where I say we're waiting for Blue Apron, also waiting for Kohl's and Macy's, which are going to give us earnings prior to the bell. Those will be very interesting indeed as barometers of American spending habits and indeed American consumer leisure activities more broadly. I love the fact that gasoline prices are so incredibly cheap right now. In fact, some of the lowest we've seen in about 10 to 15 years. Now, the fact that we are changing our activity space doesn't necessarily mean that we're not driving at all. And some of these big retailers, which are anchors to the shopping malls that we all thought were abandoned only a few months ago, could be interesting, because if we are able to get there more cheaply, we can get there more cheaply and we can spend more money whilst we're there. So it could be some upside surprise to Kohl's and Macy's, but nonetheless, those two companies and that industry writ large has been struggling significantly in the first half of the year. So let's wait to see what they have to say before we can actually draw a line under the sand of the share price declines. As I say, Dow called down about 57 points right now, 0.3%, but we'll find out what happens at the open when we get there. Thanks for watching, guys. This is 5 Before the Bell. I'm Martin Baccardax, and I'll see you tomorrow.